I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. This week, we are lucky enough to be joined by Strategas President and Head of Portfolio Strategy, Nicholas Bohnsack. And Nick, how are you doing this morning?
Very well, my friend. How are you?
Doing very well. Let's get right into it. It's been a bit of a rocky start to the year so far. There's a lot of different reasons and headwinds percolating for the equity weakness, but I wanted to get your take on it. What are you all seeing in the markets? What are you watching most closely right now to kind of explain and then to look forward?
Yeah, I think the thing that's really at the top of our mind is what's going on in interest rates, and more specifically, not just at the long end of the curve, but how the Fed is going to sort of change its policy, its policy direction. Of course, there's been a lot of attention thrown on this week's meeting. We didn't anticipate them raising rates, and they didn't. But I think the chair left us with a fairly strong impression that they'd start doing so at their next meeting in March. And so, that's a major change in tone from the Federal Reserve from what we've experienced for the last decade. So I think that's really the focus of our attentions.
So, the part of the reason that they're feeling more aggressive or feeling like they can raise interest rates is because economic growth is so strong and because inflation is so high. So with both of those things as the backdrop, how does that inform your positioning, and how does that inform how you think about growth in 2022 overall?
Yeah, we got the GDP numbers this week for the fourth quarter. They were, strong. I think anytime you put a 7 print up, very close, 6.8, 6.9%, you've got to look at that as strong. But as you say, the momentum in the economy certainly did falter as we moved into the end of the fourth quarter with Omicron, and unfortunately, in many corners, we're still dealing with that. Inflation has, as you know from our conversations and those with my colleagues, has been something we've been felt a little bit more strongly about, perhaps than policymakers have cared to let on, that it would be with us for longer and more problematic for longer. But the Fed's in a tough spot. It's not just about changing the direction of policy or making policy somewhat less accommodative off of a lower bound. They also have the employment mandate, and while at a very high level numbers are better than they were, clearly there is a bifurcation between goods and services in the economy. So they're in a tough spot, but ultimately speaking, we do think that the cyclical recovery continues, and in as much, while there might be a shift sort of in the leadership within the equity market, the economy is going to see some volatility, but probably continue to push forward into the tail end of this year.
Yeah, I think that's a good takeaway because we've certainly seen heightened volatility, but by all accounts, kind of the building blocks of a strong fundamental, bullish case are still there. A piece of that is the earnings picture. So companies have beat expectations at pretty much every turn since the pandemic, since we saw that kind of initial crest in the pandemic. We're in an earnings season right now. It's a bit more mixed. What is your read on how companies are doing and the headwinds that they face going forward?
Yeah, I think mixed is exactly the right word. It's mixed at a high level. And I think the concern is, does it become mixed and at a low level? Anytime you start to put a few headwinds into economic growth, as Omicron did, you run the risk, and certainly after we had a strong year of earnings growth, you run the risk that by the middle of this year, you could see the rate of growth in earnings fall to a level that's not particularly exciting for the equity market. And one of the things I think we do have to start to think about as investors are, do the preconditions exist for a mid-cycle slowdown to emerge? Not making a call on a recession, not making a call on anything more dire, but simply this plateauing of the first phase of an economic cycle. And from our vantage point, that will very often elicit a rotation from more traditional growth corners of the market. I'm hesitant to use the word FANG, but it's really FANG and it's peripheral, and sort of a lean into more value-oriented or cyclical corners of the market. And that's what we've been looking at. We've had a very unique circumstance where consumer shares have done well, albeit mixed, as you mentioned. Energy shares have done well and certainly have the momentum. And how long can those two live in harmony? And it sort of strikes back to your previous question on inflation. And of course, as the consumer goes, so does the US economy. So we may be in here for a period of increased volatility, probably some rotation within the equity market. And then as we get out into the middle of the year, sort of figuring out what is the slope of the next phase of this expansion.
That's great context. So when you talk about a mid-cycle slowdown, when you talk about the next phase of the expansion, I wouldn't ask you to put a number on it or forecast out much much too far because that gets really dicey. But are the legs there for a longer expansion here? Do we have the necessary cocktail of policy and growth to kind of keep this thing going for years to come? Or is that mid-cycle slowdown, could it potentially pivot into something a little more ominous?
Yeah, I mean, we always have the potential to pivot. And of course, the great unknown variable here is, how COVID reconciles how we clear the virus. And I'm thinking about that simply from an economic perspective, none of the social and human elements that are, altogether more important. So, by our lights, the economy does have the legs to continue to expand, but we are starting to get to the point where there could be some fatigue, and we need to consider the mid-cycle slowdown probably as part of our base case moving into 2023. Got 13, 14 months before we get anchored around the next calendar year, but it always has the opportunity to manifest. And of course, in this particular environment where you have a lot of dissension within Washington, you have a fairly bifurcated recovery, what they would call the K-shaped recovery. There's always a chance, but at the moment, right now, we think earnings remain robust, revenues remain robust. And interest rates and monetary policy remain broadly accommodative. Even though the Fed is changing direction, they're still, at the lower bound. So for the time being, I think recession is not in our base case.
All right, I think that's a perfect place to end then, because it's a positive outlook, some headwinds, sure, some volatility likely, but still a pretty strong bull case as the base case there. So I want to thank you so much for your time, and we'll talk to you again soon, hopefully before that 2023 outlook comes around.
We look forward to it, Ross. Thanks.